we're going to explore the crucial decisions companies make regarding their corporate financing choices. Specifically, we'll delve into the fundamental trade-offs between debt and equity for fueling business growth. First, let's define what debt financing means and how businesses typically utilize it for their operations. Imagine a company borrowing 50 crore rupees from a bank to expand, agreeing to repay it with interest over time. Now, let's turn our attention to equity financing and understand how companies raise capital by selling ownership. For example, a startup might raise 100 crore rupees from venture capitalists by giving up a 20% ownership stake. Let's clearly outline the key differences between debt and equity financing to understand their implications. We will now break down the core distinctions that set debt and equity financing apart. One major distinction lies in ownership control, which significantly impacts decision-making within the company. With debt, you do not give up any ownership, retaining full control of your company. Lenders, unlike equity investors, typically have no voting rights in your business decisions. Another critical difference is the repayment obligation, which varies greatly between the two options. Debt financing involves fixed repayments, including both principal and interest, on a strict schedule. These debt payments must be made precisely on time to avoid penalties and maintain good standing. Now, let's consider the financial risk associated with each type of financing decision. Debt financing increases your company's overall debt burden, impacting its financial leverage. A higher debt burden also translates to a higher risk of defaulting on your repayment obligations. Finally, let's examine the tax benefits, which can make one option more attractive than the other. A key advantage of debt is that the interest paid is often tax-deductible, reducing your taxable income. This tax deductibility effectively lowers your company's overall taxable income, saving you money. Let's systematically explore the advantages and disadvantages of choosing debt financing for your business. We'll see how debt financing involves balancing company control with significant financial obligations. First, let's highlight the key advantages that make debt financing an appealing option for businesses. A significant advantage is retaining ownership, as founders do not dilute their control of the company. Another benefit is the tax deductibility of interest payments, which can reduce your company's tax burden. Debt financing offers predictable costs with a fixed repayment schedule, making budgeting much easier. Now, let's consider the potential disadvantages and challenges associated with debt financing. The primary disadvantage is the strict repayment obligation. Principal and interest must be paid on time. High debt levels increase financial risk, potentially leading to default if repayments cannot be met. Often, debt requires collateral, meaning you must pledge assets as security for the loan. Now, let's explore the advantages and disadvantages when a company opts for equity financing. We'll examine how equity financing involves weighing potential growth against the dilution of ownership. Let's begin by looking at the significant advantages that equity financing can offer a business. A major advantage is no fixed repayments, which significantly reduces financial stress and cash flow burden. With no debt repayments, there is less financial risk and a lower chance of defaulting. Equity investors often bring valuable expertise, mentorship, and crucial industry connections to your company. Next, let's consider the disadvantages and potential drawbacks of using equity financing. A key disadvantage is the loss of ownership. As investors gain voting rights and decision-making power, you will also need to share a portion of your company's future profits with these new investors. This dilution of ownership means founders might lose some control over the company's strategic direction. Today, we're going to explore how to choose the right financing options, which is crucial for any business. This choice must always align with your specific business situation and your overarching strategic goals. First, let's consider a stable company, which generally has very predictable financial characteristics and operations. With predictable cash flows, a stable company can comfortably handle regular debt repayments without much stress. Using debt also helps stable companies avoid unnecessary dilution of ownership, maintaining control for existing shareholders. Next, we have a high-growth startup, which presents a very different financial landscape for funding. High-growth startups often struggle with fixed debt payments due to uncertain and fluctuating early revenues. Equity financing allows these startups to receive funds without the immediate pressure of stressful debt repayments. Now, let's look at financing for expansion projects, where the choice depends on future revenue predictability. If the expansion project's future revenue is predictable, then debt financing can be a suitable and efficient option. However, if significant capital is needed, especially with uncertain returns, equity might be the better choice. Finally, consider situations involving high financial risk, which significantly impacts the most appropriate financing decisions. In these high-risk scenarios, taking on more debt can unfortunately increase the company's overall financial vulnerability. Conversely, equity financing can help reduce the financial burden and associated risks in such challenging times. Now, let's explore financing options that go beyond the traditional debt and equity methods. We'll specifically look at venture capital, private equity, and initial public offerings for accelerating growth. First up is venture capital, often referred to as VC, a popular funding source for innovation. VC typically provides crucial early-stage funding specifically for high-growth startups with significant potential. Next, we have private equity, or PE, which plays a different yet equally vital role in funding. PE involves investments in established companies, often for restructuring purposes or significant expansion initiatives. Then there's the initial public offering, widely known as an IPO, a major milestone for companies. An IPO is when a company sells its shares to the general public for the very first time. Finally, let's briefly touch upon mergers and acquisitions, or M&A, as a strategic growth tool. M&A involves strategic deals, either for achieving company growth or for providing an owner's exit strategy. Let's delve deeper into the key features of venture capital, private equity, and IPOs. These options cater to different company stages and attract distinct types of investors. Starting with venture capital, or VC, its characteristics make it unique in the funding landscape. VC funds early-stage, high-growth startups, providing capital alongside crucial mentorship and strategic guidance. Moving on to private equity, or PE, it operates with a different focus and investment approach. PE invests in established firms for growth or restructuring, usually taking a significant ownership stake. Lastly, let's examine the initial public offering, or IPO, and its transformative impact on a company. An IPO is when a company sells shares to the public, raising substantial capital and increasing market visibility. Now, let's learn how to effectively analyze a company's capital structure using important metrics. Important metrics include debt to equity, interest coverage, and leverage ratios, plus the weighted average cost of capital, or WACC. Let's now summarize the key concepts we've covered, providing a quick recap of our discussion. Here are the most important takeaways that you should definitely remember from this lecture. Remember, debt financing is best for established, profitable businesses with highly predictable cash flows. Conversely, equity financing is perfect for startups and high-growth firms, avoiding immediate repayment stress. Your choice between debt and equity hinges on financial risk, ownership control, and your long-term strategy. The weighted average cost of capital, or WACC, is crucial for guiding financing decisions and optimizing capital structure. Finally, VC, PE, and IPOs provide distinct funding paths for companies across different growth stages. Analyzing capital structure involves using key financial ratios to accurately assess a company's financial health.